You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And today with us, nationally recognized life expert, Bobby Samuelson, and we're talking about whole life, the product that started it all.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am your host, Steve Savant, and with me today is Bobby Samuelson. Bobby, welcome to our show.
Glad to be here.
We're talking about the product that started from the beginning, whole life. And we have so many people watching our show that are 55 and older that cut their teeth on this product. Actually, their introduction into life insurance sales was whole life. Yep. And I want to go one step further than that. I came into the business almost 30 years ago with the venerable New England, and we were one of the 6 to 8 companies that were participating whole life. Not just whole life, there was a lot of non-par out there, but everybody started drifting to the dividend scene, which is, of course, we're actually handing back unused premium, right? And there's a lot of mechanics here, we'll talk about it in a second. We're broadcasting live from Fountain Hills, Arizona, home of America's largest fountain, and our national network right now has gotten so huge, we're almost at 235,000 live feeds.
Wow.
We want to thank everybody that's watching our show and part of our show. And today with Bobby in-house, if you go out to his website, what is your website again, Bobby?
TheLifeProductReview.com.
And you can get his subscription. I go out there, there's some really great white papers out on the web on Bobby. And of course, he does huge institutional consulting with some of the top name carriers in the country. And I don't know if you do any international, do you?
Not yet.
Not yet. Okay. Well, there's just a little tip to all our carriers who have foreign parents as companies.
I like to go to Bermuda, right?
There you go. And there you've heard it from Bobby, and you'll get Bobby. Let's talk about whole life because it's been around forever now. Okay. And when I think about whole life, back in the day, there was only whole life and ART term.
Yep.
There was none of this 5, 10, 15, 20-year term. We're talking strictly whole life. When you think about it today, is the bloom off the rose of whole life, is it really dead as a product, or is it making a comeback?
No, it's definitely not dead as a product. So a couple of stats I think back that up. First of all, the whole life carriers, the mutual companies, have had explosive growth in the last 3 or 4 years. So whole life is absolutely picking up, and I get to see industry data every now and then, and it's pretty obvious that anyone who has a whole life company is actually selling quite a bit of it. So whole life is doing well as a product line. People like to talk about indexed UL as the fastest growing part of the life insurance business. Hot on indexed UL's heels is whole life, believe it or not.
Why the revival? Because I did see there was a time where it kind of really was actually decreasing in total premium.
Right.
Why is it holding its own? Or in your case, you're saying, hey, it's clicking at the heels of IUL.
I think there are a couple of reasons. Number one is there is a large field force of agents with mutual companies who sell a lot of whole life. So to some degree, whenever the market comes back, whole life is going to come back with it. But I think broader than that, there's an attractive story to whole life that is really starting to come out in this interest rate environment. So when people look at savings alternatives and they look at CDs and whatever else, they're looking at rates in the 0.5%, 1% range, whatever it is. And a mutual agent or a whole life agent can show up and say, look, I can give you a 6 or 7% dividend on this whole life product. Doesn't that sound attractive? And I say, yeah, that sounds attractive. So I think a lot of what whole life's appeal has to do with right now is just simply the fact that dividends are a lot higher than interest rates in the economy, and so when you look at the returns on a whole life contract, they look pretty good. I mean, they're really structured for cash accumulation. So
I would say probably the whole life detractors would say, but you're only a dividend's only returning unused premium. How can that be attractive?
Yeah, and that's where anytime you get in this discussion, right? There's a sales story and there's an actuarial story.
Right.
So, obviously there are a lot of arguments against why a 7% dividend isn't really 7% cash on cash earnings, no question. And so I really think actually the best way to look at whole life is to look at the IRR on the cash value over the long term of the contract. And that way you get away with, what's the dividend? You get away from what's the dividend rate as a useful tool, and instead you just look at the IRR on the cash value, premiums paid, cash value available. And even if you do that, it takes a few years to get to it, but 10, 15, 20 years out, you're looking at rates of return at 3 or 4% if your dividends are at 5 or 6%. So even if you sort of exclude the idea that a 7% dividend is really 7%, the performance of the product itself is actually still pretty attractive. And I just think fundamentally people are looking at long-term low rates, very flat yield curves, and they're seeing dividends and they're saying that looks pretty attractive. Now, will dividends hold up in low interest rates? That's another issue, right?
Well, when I think about it, and again, this is certainly not any major plug for mass Mass Mutual. I just call it the way I see it. But I saw in their 2012, they upped their dividends when many of their competitors in the whole life space actually went flat and or decreased. And I noticed that their actual income scenarios with their contract started to rival what I would call lower quote IUL proposals. Now that was a shocker to me that they were in the game. So this was a big comeback. Now I want to erase something and maybe to talk about this. I just want to get non-par off the table just for a moment. I don't have dividends. It's just a guaranteed premium.
Right.
Is that gonna survive out in a marketplace when I can get GUL for less?
Yeah, that's a great question. And a lot of people try to say, well, whole life is the best of both worlds. You get guarantees and you get cash value. Well, the reality is the guarantee side of the whole life ledger is not attractive. So if you're buying it just for the guarantees, like you said, you really ought to go with GUL. The dividends are really what make the product work. And also too, fundamentally, think about premiums on a whole life contract are 2 or 3 times what they might be on a GUL policy. Well, if you don't get the dividends, you could have bought 2 or 3 times worth of death benefit on a GUL contract. So really, again, the dividends are the driver of the performance if you're buying it for death benefit, no question. And otherwise, the policy is not particularly attractive.
Well, not that I want to force you to make a prediction, but I'm just thinking if I have non-par product out there, and they are, I just came off full disclosure site and looked at the entire whole life spreadsheet grid, and I noticed here are the non-par and the par, and I'm thinking, just what you said, my GUL, those numbers, I'd be able to buy much more or pay less.
Right.
Is that going to stick around then if it doesn't have the dividend story?
Non-par?
Yeah.
Yeah, I don't know. I think that's really going to come back down to pricing. And sorry, I think I may have misunderstood your previous question when I was talking about the dividends. The deal with non-par whole life is that's a function of basically interest rates, guarantees, and how they can price a product. And non-par I don't see as being a big driver in a low interest rate environment. It's really all about the dividends, and that's going to come from interest rates.
Wow. Well, when we come back, we're going to talk about dividends and how they use it and does it work. Remember, you can contact me right here at thebiz@brokersalliance.com or just call 1-800-290-7226. Watch our show and head out to our website, www.brokersalliance.com.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Helping people with their finances is a great responsibility. Taking care of the families you serve requires more than just providing protection. It means helping them take smart steps towards building a successful future. A good first step is offering the Ultra Index, a low-cost life insurance product that accumulates cash values your clients can access for emergencies, college tuition, or additional retirement income. That's the Ultra Index from Lincoln Benefit Life, an Allstate company.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant. With me, of course, is Bobby Samuelson. We're talking about whole life today on our show, and we talked about non-par, first subject. I just want to get it off the table because actually it's just retreating in total premium, net premium sold. It just isn't a player. But participating life, in my view, make it a comeback. Bobby just supporting it with a lot of the things you said first segment. But I want to get into dividends because tomorrow we're going to be talking about guaranteed UL, guaranteed universal life, and a lot of people are fishing out of the same bond debenture pool.
Yeah.
So even whole life has the same issues as GUL. So I'm fishing out of the same pool. I'm trying to reduce my home office expenses so that the combination of reduction of expenses and my ability to pull some numbers off my bond portfolio generate excess numbers, which called the dividend. I'm trying to produce that.
Right. So your question really is, I see a lot of stress on the GUL side because of low rates. Why isn't that translating into whole life? Yeah, okay, so that's a great question. First of all, when you look at what mutual companies actually invest in, right, and companies that have whole life portfolios, where they actually put their money, it's not always into fixed income assets. So Mass Mutual, for instance, I don't want to quote direct numbers because I can't remember them exactly, but they have a lot of their portfolio in non-fixed income things, partnerships, real estate, stuff like that. So low interest rates don't necessarily hurt mutual companies the same way they hurt stock companies with no lapse guarantee policies. So that's one thing. Second thing is, with a whole life policy, there's a few features that make it much more predictable, even in a low interest rate environment, and it's easier for carriers to to shuffle the yield around. In particular, the premiums are guaranteed. You have to pay the premiums, and if you don't pay the premiums, it comes out in a policy loan. So what that does is provide a consistency of performance in the block of business, which basically allows you to do more with less. Because on a universal life contract, you have flexible premiums, so that in and of itself is a risk to the writing company. But with whole life, policyholders can only do a certain set of things, right? They can receive their dividends a couple of different ways, and but they have to pay a premium every year. And so basically, it allows companies again to take those yields from the bonds, know exactly what they're dealing with, and repackage that as dividends. And so basically, if you were to have dividends in, say, a universal life structure, you couldn't provide the same dividend level, again, because the consistency of whole life is just a lot more, it's just a lot more consistent than UL. And then there's the expense piece, right? So MetLife is fond of saying that other carriers like to increase their dividends, but also increase the expense loads. And so the net result is neutral. And that's something I'm not an expert in whole life, is something producers ought to be aware of. It's just because the dividend goes up doesn't actually mean that the performance of the contract is going to go up, because they can tinker with other levers in there. And so MetLife's done a great job of kind of doing due diligence on who's doing what in terms of dividend crediting in the industry. I
love their competitive intel on that. And remember, we tie into that all the time. So I watch their language and they're experts in that field. And then we also have to pick the bones out, because we got a little bit of propaganda there too. But that's okay, because we know how to do that. Here's the thing, dividends, low interest rate environment. I just saw a proposal, perfect example of this. I was reduced to paid up with a term rider on it. So I'm trying to reduce my premium, hoping that the dividend will perform to do that. And I want to be able to not only reduce it, I don't want to pay it. Right. I hope it's big enough. And I have to convert my term rider all along the way, on top of having paid up additions sometime in the future to kick up my death benefit. Now, to me, there's only so many moves on the checkerboard.
Right.
That sounds like a lot of pressure, and I don't see them having any other magic show than a GUL platform may have. Tell me a little bit about that.
Yeah, so your question really, if I can rephrase it, is basically you're saying there's a lot of things these dividends have to do. And if those interest rates keep going down, dividends go down, you can't have all those things at once. You're going to lose some piece of the equation. You're going to have to pay a premium, your term rider's not going to get pulled off, not going to get your paid up ads. Is that kind of what? Yeah, so, and I think that's really where, when agents sell whole life, we've always had a problem with overselling the benefits of the dividends in the long run. And so look at the, vanishing premiums in the 80s. That was a high dividend. Same thing, dividends are paying your premiums very early on. And so I just think, it really comes back to the agents saying, all right, we know we've habitually over-illustrated whole life. We know that interest rates are low. We know that dividend rates probably will end up going down if interest rates don't pick up here in the future. Pick up steadily and consistently. There can't be a spike. A spike would be a major problem for the insurance companies. So really what they ought to do is just show illustrations with lower dividend rates and see what the client might have to pay. I mean, fundamentally, the value proposition of whole life is great in that there is a kind of minimum guarantee set to it, and the dividends offset that, whatever they're going to do in the future. But you shouldn't just take the current dividend scale and project it out in one illustration. You should show lower dividends and even lower dividends to say to the client, look, worst case scenario, this could be as bad as it gets. And that way you're talking about the dividend doing all these things. You need to set the client's expectations realistically that, hey, right now the dividends are supposed to do all this. If interest rates stay low, dividends drop, I may have to come out of pocket, and I'm okay with that. I still believe in the value proposition of the product.
I think I haven't seen, and I'm just being truthful, I have not seen a proposal from a whole life carrier or in competition, and we are in competition all the time, where somebody has suggested a lower dividend.
Yeah.
I have not seen it. I've seen it on indexed universal life.
Sure.
But I never see it on whole life. Now, why do you think that is?
Yeah, I think dividends are a source of pride for people who sell whole life. I mean, when you're a mutual guy, you've been selling insurance from Northwestern Mutual, whatever, for a long period of time, you can talk about your company's strong dividend history. And so suggesting the dividends are going to go down in the future is, I don't want to say it's an insult, but it's sort of an insult, right? And so I think a lot of times guys just say, well, this is the dividend scale and we think this is sustainable and here's why, when the reality is dividends are going to change.
Well, I'm trying to think about this strictly from 1990 point of view. Since 1990, it's been a complete decline.
Oh yeah.
So there is no historicity of even holding, much less increasing.
And that's interest rates. Interest rates have been dropping for 30 years.
Right.
So,
well, when I think about it, when I think about the ability to punt and go to policy loans, because you were saying in early, well, if you didn't pay, then a lot of people check the automatic premium box.
Yeah.
Now, and I'm not against that, but just remember that I've seen carriers now whose balance sheets are double-digit in accounts
Policy
receivable
loan. Yeah.
on policy loans, the very thing we told them that they didn't have to pay back.
Yep.
Well, Bobby, we're going to be out. He's been with us all this week. We'll talk about all these things. You're listening to the Business Insurance Zone. That's the Buzz on the Biz for today. I'm Steve Savat. See you tomorrow.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.